The broadcast of information on this show does not create an attorney-client relationship with any of the listeners. Communication between the listener and the hosts of this show will not be confidential. The information provided on this show is prepared for a general audience without investigation into the facts of each particular case and is not to be considered legal advice. The information provided on this show should not be used as a substitute for legal advice. The listener is advised to consult with a qualified attorney on any legal issue they may have.
Hey, good morning, KDWN News Time, 9:05. John Schaefer with you, and it is Wednesday, 9 o'clock. That can mean only one thing. Tisha Black from Black & Labello with us once again to answer all of your real estate legal questions. 257-5396, 257-5396 if you have a question for Tisha. And Tisha has a special guest with her this morning. Good morning, Tisha.
Good morning. I do have a special guest with me this morning. It is Mark Baker of Sierra Pacific Mortgage. As promised, in the last couple of weeks, we had several callers call in regarding what the impact was on their credit and the outlook for gaining new lending on residential properties in the future after a short sale or foreclosure. So I brought in Mark. Good morning, Mark.
Good morning.
This is his first time on the radio, is it?
First time in a long time.
Oh, okay. So we were going to just start in with, actually, I spoke with Heidi and listened to her show, and she was talking about some government programs, and Mark and I were discussing one this morning, the FHA Short Refi program, which is also another government program that's had a dismal effect. Essentially, that program was to refinance houses that were underwater. The FHA was going to do it. And as long as the house, it was a primary residence, and the house was more than 115% loan to value, right? Negative equity, then the government was going to allow you to go in, get a principal reduction, and pay get a principal reduction. And the government would then make up the difference to the lender. They would write it down. And I think it was it up to 30%?
I don't think that there was a limit to it. They just said that it had to be more than 10% that they wrote off. Okay. was the main thing that I remember. So
here's the stats on this one. The program was funded with $8 billion, capital B is in black.
Okay.
$8 billion. They've today, it's approximately a year old. They've today spent $50 million with an M. $50 million, and they've helped a total of, what's your guess?
6.
301 people, nearly 6. So
I was close.
So I think that isn't that essentially, you did the numbers, it was like
It's $166,000 per transaction, basically, that's been spent.
And I'm wondering what kind of customer service those individuals have.
Yeah. So is this a program that's available only to people that already have FHA loans or to anyone?
Well, in fact, that's an interesting question. It's if you have an FHA loan, it's not available.
Oh, nice.
So they've got to get the loan servicer to write down the mortgage, is my understanding. We don't participate in it because we thought when it first came out, we got hundreds and hundreds of calls, and we just said, I don't know how real it's going to be. There's a lot of these government programs that come out that you can do all these great things, but it's, they put all the parameters on it and all the guidelines. It makes it where nobody can really do it.
Yeah, at the risk of having Heidi come back in here and attack me, I have an FHA mortgage. I asked.
Well, it looks. Let's just talk briefly. Let's just talk briefly about credit impact, because I know that's going to be a question. It has been a question of a lot of our listeners. Mark, what is the result? After you have a good credit score, somewhere between in the 700s, 800s. Mm-hmm. What happens after a short sale to that credit score, or during the course of a short sale? What happens to that credit score?
It depends on whether you go delinquent on your mortgage or not. If you go down on your mortgage, it affects it dramatically. If you don't, your credit report just comes back and says settled for less than owed. I'm not real convinced that affects your FICO score much at all. I have personally witnessed somebody who had 5 settled for less than owed mortgages on their credit report, and they had a 717 FICO score at the end of the day. But I know that there was also one derogatory of a 30-day late, and that was not true because I investigated with them. Mm-hmm. So there was one 30-day late mortgage on there, which wasn't true. So we were in the process of getting that removed, and I don't know where that stands.
So as a lender, then, if you see somebody that has a settled for less than owed, they come in and they say, Mark, I short sold 3 weeks ago. I was one of the 1 in 17 million that was actually able to short sale while current, because that's an anomaly. You wouldn't, and his credit report was marked paid less than due. Settled for less than owed, right? Settled for less than owed. Excuse me. That wouldn't be. Was that even a speed bump to getting a new loan? And what's the time frame? The Federal Housing Administration, you can get an FHA loan immediately after a short sale, as long as you didn't have any 30-day lates. And if you had 30-day lates, because don't you find that that's more common that people
It's much more common.
Right.
It's much more common. Most people don't believe that you can do a short sale, that you can execute a short sale without being late on your mortgage. I know most of the real estate agents say that's the fact. I believe most of the attorneys. You're an attorney. I mean, it's most people say.
I have seen it. I have seen it accomplished.
Right.
But it's few. It's very few and far between.
It's rare.
It's not for lack of effort.
Right. You have to be persistent. You have to be negotiating it yourself, type of thing. I mean, it's a lot of phone calls to do it. But it was 5 different lenders, so it
can get.
It can be done. It's rare. I've coached 2 or 3 of my past clients who are very good friends of mine to do it, and I've had, needless to say, hundreds of calls. Hey, Mark, can you help me? And there's just no way. I mean,
right.
I couldn't charge enough money to help people do it because it's just so time consuming.
It is so time consuming. So we have actually a couple callers already. Let's start with Dave.
Dave, good morning.
Good morning. I was listening to your show and I listening to the FHA part of it. And a friend of mine just the other day inquired about getting an FHA loan to reduce his payments on his house already. And the part that turned him off about it was that when he inquired that the mortgage insurance was going to be double of what it previously was. So instead of a couple of $100, it was going to be like 4 times the. I'm sorry, if it was $200 or if it was $300 a month, it was now going to be $400 to $600 a month. Do you know anything about the mortgage insurance going up like that?
Yeah, I know a lot about FHA mortgage insurance. That sounds like a big number to me. Your FHA mortgage insurance, you have an upfront mortgage insurance premium of 1.15% of the loan amount that gets financed in, and then it's 1% monthly of the loan amount. So not looking at it, not having the paperwork in front of me, I would just have a hard time believing that his mortgage insurance was going to go up 4 times the previous MI.
Where did you?
I didn't mean 4. I meant twice. He said twice.
Well, that's possible double, because some of the mortgage insurance factors on a conventional loan are 0.3 or 0.4, 0.5%, depending on the FICO score and your loan to value. So that you could be right there. It could double the mortgage insurance. That's possible. I'm with you there. That makes sense.
Yeah, but from what you're saying, it should only be a certain percentage, like you said, 1 or 1.5% of the loan amount.
Yeah, 1% of the loan amount is what the monthly mortgage insurance factor is. So you take the loan amount times 1%, and divide that by 12.
Okay. All right.
Good question.
Well, thank you for that. Anyway, I just thought I'd mention it.
Not a problem. Thanks for the call.
Thank you, Dave.
Okay. Bye-bye.
I have a question about mortgage insurance while we're on that topic. What exactly does it do? If you have mortgage insurance, why are so many of these houses being foreclosed on and banks being owed money? Shouldn't the insurance take over and pay back your mortgage for you? Theoretically, yes, they do. And the mortgage insurance came out back in, I don't know when mortgage insurance actually came out. I'd have to look that up. But the whole point is if the borrower defaults on their loan, back in the day, you had to put 20% down to buy a house, right? Period. And then in the 1930s, the Federal Housing Administration was born, and they came out and said, okay, we're going to allow people to buy houses with less than 20% down. Well, they started out by extending. It used to be that the loans were short. They were essentially all balloon payments, 5 years, 7 years. And then after World War II, when the GIs came back home and they wanted everybody to have a home, and there was also an increase in the technology in home building, that they were starting to use the fabricated homes. The ones, those in New York and New Jersey, they have all those. Town. There you go. Exactly. They decided that they had to find out a way to make loans longer. Because there was such rapid turnover, and most people weren't able then to get the loans paid in the 5 to 7 years that the term typically was. Right. So they came up with the GSEs, the government
Government-sponsored enterprises.
Exactly.
That's exactly right.
And then they started slowly but surely increasing the rate. It was first 15 years, and then it was 20 years, and then I think it was 23, and it ultimately landed at 30 because most people returning from the war would work 30 years, and then they would retire.
Wow.
That's exactly right.
Huh.
Because to have a 30-year note as an investor is an anomaly. I mean, it's
Right.
you don't want it.
I don't know if any other countries have 30-year mortgages, quote unquote.
I don't think they do. I mean, I think they've actually tried the program, but it's tough.
Right.
So mortgage insurance, to get back to the question.
Yeah, mortgage
came in
insurance
the
was
70s.
right. It came out to say if you could put less than 20% down, it was a bigger risk for the investor. So the investor required you to get mortgage insurance, and mortgage insurance factors are determined by the amount of money you put down or your loan to value and your FICO score. Basically, I mean, mortgage insurance wasn't available for a lower FICO score, so to speak. But on the higher FICO scores, you could get mortgage insurance, and you could get reduced factors with a higher FICO score.
Here's another historical note. I should be on Trivial Pursuit for information that nobody really cares about. FICO is the Frederick Isaacs company, right?
Fair Isaac Company. That's exactly right. Mm-hmm.
And they had no way to measure what your credit worthiness was. So that came out, I think, in the 50s. In the 50s or the late 40s, because they were not, they didn't have uniform factors as to how to underwrite a loan. Mm-hmm. So the FICO score came out, and then in the 70s, I believe, the late 60s, 70s is when they started the Fair Debt Credit Reporting type of regulations, and that emerged into the body of law that we love and cherish today.
And welcome back, KDWN News Time 9:19. We're with Tisha Black from Black & Labello and Mark Baker from Sierra Pacific Mortgage, answering all of your mortgage and real estate legal questions. Good morning to both of you.
Good morning again.
Tisha, who would you like to go to on the
Let's pick up
phones?
Carl. He has been hanging for a while. Hi, Carl. This is Tisha Black of Black & Labello.
Hey, Tisha, by the way, good piece of trivia on Levittown. I'm from the East Coast. I know the house as well.
Well, thanks. John picked up the name.
I'm from the East Coast as well, so I'm familiar with Levittown.
I just got a quick question. I have to go to class, so I'll make it as brief as I possibly can. Forget about that I lost a bunch of houses. I'm a real estate investor. I was from back east, and now I come here and I got wiped out. I wasn't a Johnny-come-lately, so I've been investing in real estate since 1983. But my question is on the primary. Mm-hmm. I was one of the few who's managed to get my loan modified without hiring a lawyer. I did it myself. It took me a long time. They really didn't do much, but They modified it where my interest rate is now only 2.8%. But I'm severely underwater, and I feel I'm wasting money. Not so much on the first, because I'm close on the first, but on the second. The first is maybe $100 underneath, and I'm paying $1,000 a month towards principal,
right,
because of the modification. But the second, it's a wasted asset. You know, the second is $200,000. My wife will shoot me if I get foreclosed. But the problem is, it's like, why am I paying this money?
I would have more trepidation over your wife than the second at this point.
But the bottom line is this: I just don't want to pay the second anymore, and try to negotiate with them on the second.
Well,
and you hear
you
a
can
lot of
certainly
law firms out there advertising this, but what's the deal with that?
So you know what the deal with that is that you got to file bankruptcy. And what they're talking about is stripping the second, and there's a lot of I don't want to say regulations, but there's a lot of criteria that you have to meet before you're going to be able to strip the second. And bankruptcy, I think, Mark, is the worst thing on your credit score, isn't it?
Well, I haven't filed bankruptcy, and I don't want to file bankruptcy.
Right. You know what I would suggest, Carl, is calling the second, because the second is probably not in the money anymore in terms of the value of your house. I would call them and see if you can settle it. We've been successful on doing that, where the second's no longer in the money and just settling it. The other thing is, obviously, and kudos to you for getting your own modification done. That's fantastic.
Yeah.
I don't know what kind of class you're going to, but you're good at real estate. You're obviously continuing to educate yourself, and you got some moxie on negotiating. So I would try calling that second yourself and see if you can unwind it. Yeah.
I have a lawyer who's coaching me, but he doesn't charge me because,
it's the best kind of lawyer.
Yeah, he's great.
That's what we use Tisha for as well.
All right, Carl, we got to move on to some other callers.
Thank you so much.
Have a great day. Take care.
Great show. Bye.
All right, let's check in with Chris. Chris, good morning.
Hold on. Hello, good morning.
Hi, Chris. How are you? This is Tisha Black of Black & Labello.
Good. Hey, I was interested in, or I was concerned about, I let a house go back in 2010, and I had inherited, come into an inheritance this year, and when I went to Wells Fargo looking to put half down, three-quarters down on a home, I was told that I couldn't purchase a home. Is that true?
What kind of loan did you have in 2010? What was it?
Conventional.
Okay. So, Mark, this is probably a good question for you.
I haven't heard this question since yesterday.
Right. It's the same one, right, where they're told they can't.
Right. You have a great question, sir. It's difficult to get an institutional loan when you're in your situation. In other words, Fannie Mae's guidelines, Fannie Mae and Freddie Mac, there's all kinds of different guidelines without boring you with all the specifics. Chris, you could get a loan through a couple of portfolio lenders. Let's just put it that way. There are companies out there doing it with 50% down. Obviously, most people are going to think about private money.
What's a portfolio lender?
A portfolio lender is a non-very large bank. In other words, you got your largest banks in the nation that do mortgages. Right. You got your B of A, Wells, Citi, Chase.
Right. So, if he went to a community bank?
If he went to some smaller banks, they might take a chance with him. We have a lender that's an arrow in our quiver that we can do a loan 1 year out of a bankruptcy.
Could you get him a loan for, half or three-quarters down?
If his FICO scores are decent, absolutely.
Chris, why don't I think this is a good question because there's a lot of people who have the ability to put money down and maybe are shy on income, but certainly they're,
That's exactly right. We've got one loan that's an 80% loan to value, 1 year out of a bankruptcy, 1 year out of a short sale, 1 year out of a foreclosure. Mm-hmm. And as long as you didn't have more than $100,000 written off, I want to say is what it is for consumer debt if you did bankruptcy. Right. And as long as you had a valid hardship when you let the house go down, you had loss in income or whatever. But we've got a loan that's available.
Chris, it may be a little bit of work for you, and your loan that you ultimately get may not be traditional, like a Wells Fargo or a B of A, and depending on your circumstance with them in 2010, assuming that you had or if you had one of the national banks, maybe you don't want to go back there. Mm-hmm. So what I would do is what Mark is talking about is seek out maybe a portfolio lender or a smaller community bank that doesn't have the same rigorous guidelines that the larger banks have.
Right. No, they're lending their money based on their portfolio of money in the bank.
So, Chris, if you want further information, just email me at blacklabellolaw.com, or you can call Mark Baker at Sierra Pacific Mortgage. What's your number?
451-1040.
451-1040?
Uh-huh.
1040.
Yeah, 10.
Excellent. Okay, thanks, Chris, for the call. Take care.
Thanks for your call, Chris.
Have a good day.
Thank you.
And, you do hear that all the time, people who are considering a foreclosure or need to walk away from the house being worried that they're never, ever going to be able to buy a house again. Mm-hmm. And people in general just really make it sound like it's a horrible, horrible thing and you won't ever be able to get another mortgage.
What is a banker going to say? Do you know what I'm saying? Yeah. What's a banker going to say to you? Right. They're not going to go, oh, hey, that's great, strategically default, walk away, whatever, have your house foreclosed on you and we'll lend to you. They're going to try and make it difficult. But the reality is lenders got to lend. Fish got to swim and lenders got to lend. I think that's from Nemo, right?
That's right. Fish got to swim.
I remember Nemo saying lenders got to lend in that song.
But, we're the 28th largest metropolitan city in the nation. There's just no way that there's going to be private capital that comes in here, like Mark says, these portfolio lenders that are going to see an opportunity in this market, and they're going to pick it up. Unfortunately, most of our borrowing population is used to going to, they're going to watch a commercial, see Wells Fargo, see B of A, see Chase, go to that branch, and those are the culprits that are going to make it difficult for you and tell you you've absolutely just screwed yourself by defaulting. And you got to be creative, and you got to think, and you got to search, and you can get a deal. There's deals out there.
There are deals out there, and there's loans out there. I got just a quick story real quick. We had a gentleman that called yesterday, wanted a loan. He had VA eligibility. He had been to 2 real estate agents who told him he couldn't get a loan because he had a short sale just over 2 years ago. He's got totally reestablished credit. He talked to one lender, said that he couldn't get a loan. So anyway, I started asking questions. He had VA eligibility, and the VA guidelines say 2 years out of a short sale, 2 years out of a foreclosure, 2 years out of a bankruptcy, et cetera, et cetera. The guy qualifies for a loan. He doesn't believe me because he's had 2 real estate agents and 1 mortgage lender saying you can't get a loan.
But it's all about, I mean, when we had this discussion earlier about there's different, there's FHA and VA, there's conventional, there's all different types of loans out there. And just because one requires, has requirements of X, Y, and Z doesn't mean the other disregards
guidelines are all different. That's
X, Y, and Z
right.
and has 1, 2, and 3.
That's exactly right.
But we do know that if you have defaulted or had a foreclosure and there was a deficiency on a VA or an FHA loan, until you cure that deficiency with those particular entities, you are forever barred from a VA or an FHA loan. But that doesn't mean if you're barred, you can't go get. I mean,
a conventional loan.
You can get Fannie, you can get Freddie, you can get whoever, Uncle Bill. I mean, there's other stuff that you can do, right?
Absolutely.
The same with the MI companies is if one MI company refuses to give you insurance, doesn't mean you don't go shop the other MI company.
Right. We just need to know who the loss was. I mean, if you had a loss with one specific mortgage insurance companies, there's several mortgage insurance companies.
Right.
You don't get put on a blacklist with all mortgage insurance companies.
Because they're separate vendors.
Absolutely.
They're just vendors. So you can buy it's like buying shoes to put. I shouldn't say that because I'm a girl and I'm going to have the shoe thing going.
I somehow think that you know about all the shoe vendors.
But, I mean, you can buy shoes at all different places and you can buy all different kinds. I don't think loans are not much different, and people need to look at them that way instead of a big, scary, convoluted, what do I do mess.
Right.
So we have several callers coming up after the break, Tim, Brian, and Michael. Please hold on and we'll get to your call as soon as we get back.
Hey, we are back with Tisha Black from Black & LaBello. Her guest today, Mark Baker from Sierra Pacific Mortgage. If you have a question, 257-5396. Let's get back to the phones. Michael has been on hold for quite a while. Michael, good morning.
Hi, good morning.
Hi, Michael.
I had a question about, I'm, like everyone else, I owe more on my home than what it's worth, but I'm in good standings with my credit. I've got good credit. I've never been late on my payments, but I'm trying to lower my rates, my interest rate. The mortgage company I have right now pretty much doesn't want to talk to me, only because they're getting their money out of me right now. So to lower my rate would mean less for them. Who can I talk to get a lower rate?
Michael, that is a tough one. Here's the bottom line. There is a loan program. There's one loan program. If you have a Fannie Mae loan, you can go to your computer and I guess just Google it. There's, does Fannie Mae own my loan? And it's going to pop up a website. You can put your information in there, and it will come back and tell you if Fannie Mae owns your loan or not. There is one loan program that will allow you to do a refinance at 125% of the value of the house. But that's your limit. That's where the problem is. Most people, they owe 150 in their house, or they owe 300 and their house is worth 150. So the 125% rule.
My house supposedly in the area that I'm looking at is roughly around like 65 to 70,000 is what the value is. I owe roughly about 120. I have a second mortgage on it also.
Yeah.
So that's what I owe. So
well, if you can,
I'm making the payments fine, but it's just why can't I get a break and get a lower rate too?
Because you're doing the right thing.
But this is what I mean. This is Michael's issue. Is the same? Everybody is pulled into this into the real estate market program or problem, because Michael, who can pay, is now forced, to suffer through a negative equity position because of not only the market, but I'm sure there's foreclosures in your neighborhood, correct, Michael?
Yeah, there's foreclosures in the neighborhood.
Yeah, and that continues.
Funny enough,
it continues to pull down the houses.
I'm seeing people that don't even owe. They stop paying, and the banks aren't even repossessing the homes yet because there's a flood of them already. So
they say that of the 44 million houses in the United States that are mortgaged, right, or have a deed of trust in our case in Nevada, a full 11 million of them, 1/4 of them, are in a negative equity position. So it makes it really difficult when you see, I mean, you're in a rock and a hard spot because you're paying into an investment that is really not going to come out, green, or what did they say, in the black? In
the black.
Yeah,
right.
I like that. Your investment's not going to be in the black again for 20, 30 years, if and when we start to increase in property values at the normal or historical clip of 2 to 3%, and yet you can't get somebody to refinance it or give you any relief. Right. I will tell you, in the new jobs program that Obama has created, there is said to be a program for people just like you, Michael, that have been current on your property and need a principal reduction in order to entice them to stay in the property. So while I don't think you're going to be successful in getting any type of refinancing unless you have the ability to pay the margin, which is the difference between what you now owe
and 125%.
And what's right. I don't think you're going to be able to get a new loan, but you might want to wait because this game does change constantly.
That's very true.
So you might want to wait for a new program. And you know what? Keep listening in because I'm keeping my eye on that new Obama one.
Yeah, let's keep in mind, though, and Michael, she brought up a very good point. Here's the thing. The programs that are successful or not successful that the government comes out, all of it goes back to, why would we refinance your loan? No other lender is going to come on and refinance it for the current value and take on the risk and take it away from the current lender. Does that make sense? In other words, if you're upside down. So your options at this point are really just to get a modification of your loan note, which we've seen that it's rare. And
is your note on an arm at all?
I'm sorry, say again?
Is the note on it, does it adjust or is it fixed?
Yeah, do you have an adjustable rate mortgage or do you have a 30-year fixed?
No, it's a fixed, 30-year fixed. And see, that's the thing. If I do the modified loan, doesn't that mean I have to stop making payments? Then I go through the whole process of, well, now you're in default. You're not doing this. Now my credit score that I've worked my butt off to make great
is going to get trashed, right?
Go down. I mean, it only goes down 100 points from what I hear, but it still, it still takes time for that to come back up. And I don't want to do that.
In theory, Michael, you shouldn't have to quit paying to get a modification.
I've already tried that process, and that's what they're telling me I have to do.
I'm telling you, and then there's reality, right? And then there's reality because most people end up either they're told to quit paying or they actually quit paying because they realize that they're just bleeding their savings. But you're the poster child for the problem.
You are.
You're exact, and there's virtually right now, as it presently exists, there's not much that can be done for you. Unfortunately, if you're trying to maintain your credit score and you're trying to get a modification or some sort of relief on the loss of equity in your home, and it's
right.
Believe me, I wish that we look every day. I mean, I do because I have a lot of clients that have these problems. It's there's a report that came out today actually with the Inspector General of the FHFA or some, I can't remember, but they were looking at modifications and why modifications were rejected. And one of the reasons was they were rejected because the buyer, this was by GMAC, the buyer had not been in delinquency position for more than 60 days. That was their reason. That's not even a reason of the program.
It's not.
It's not. That was an in-house requirement that GMAC apparently put on modifications that had nothing to do with the government program under which these people were trying to participate.
Didn't the government program also say that if you, during the modification process, went down or you made the modified payment, the temporary payment, they wouldn't report to the credit repositories that you were delinquent?
Yeah.
For 3 months, 90 days, was it correct?
Yeah.
So it wouldn't hurt your FICO score technically.
But they report the second they can.
Right.
I mean, Michael, so right now, I feel your pain. I know I see it every day, and I'm sure Mark does as well. The best that we can do is if you want to protect that score, continue paying, try for a modification again. But really, I'm sure that's going to be a futile thing until we get a new program out there. I hate to have you just waste your time.
So if you're good and you owe the bank the money, but you're paying them the money you owe them, they won't reduce your interest rate, so you'll keep paying back the entire principal, even though your house isn't worth that, even though they'll make a little less money in the interest. But if you stop paying so they're getting no money from you, they'll consider it, but most likely end up taking your house and selling it for less than what the original amount you paid for it was, so lose even more money than the principal plus the interest.
John, you're starting to sound like a banker.
Wow.
Yeah, that's it. It's incredible.
Genius. That is a
it's
genius
incredible.
plan.
But the fact is, the banks don't want your house. You know, a lot of people call me smart. The bank just wants to foreclose. And I'm like, dude, the bank does not want your house. They've got plenty. They're not in the real estate
business. Let's be clear. It's not the bank either. It's the servicer. The servicer gets paid more money generally for a foreclosure than it does for a performing loan, which is part of the reason that everybody questions why it is that the servicer tells them, like they told Michael, to default, right?
Right.
When the reason why is because they get more fees and they can trump up the drive-by, appraisals and the rest of the things that they do. Interestingly, he brings up another point, is the ARM. I have a lot of clients right now who are getting spectacular relief because their arms are setting again.
Right, they're resetting, right? They're adjusting.
So I've got one client of mine who had a $2,200 a month mortgage, and it's now been dropped by $1,080 because his arm reset.
Well, I thought arms reset the other way. I would have got an arm if I knew it meant it would reset down instead of up.
Well, who knew, right? But what our interest rates right now are sick. They're crazy low.
Yeah, 30-year fixed is just like yesterday when I left the office was like 4.125 on a 30-year fixed conventional loan with no points. An FHA loan yesterday was 3.75. 30-year fixed, no origination, no discount points.
I mean, that's unbelievable.
It's unbelievable. But these adjustable rate mortgages, when you look at the margin and, whatever they're tied to, the Fed funds rate is, as long as the Fed funds rate's low, these arms are going to be low. We're talking to a lot of people are going down in the twos. It's going to be low for a
long time, don't you think?
It's going to be low for a long time.
Yeah. Okay.
So if you've got an arm, don't touch it.
Don't touch it. Let's see. We have Tim. It's a question about judicial review.
Tim, good morning.
Hello?
Hi, Tim.
Yeah, hi. I had a question about I had a foreclosure mediation about a couple weeks ago, and we didn't come to any type of an agreement at it. That was the outcome of it. And also part of the outcome was that the lender failed to bring to the mediation. They had
the documents they needed?
Yeah, the documents. I kind of have it written down. It was the wet certifications of the note, the deed of trust, and the assignments. And then I guess also the transfer of the note to Fannie Mae was missing.
The allonge.
Oh.
So what I was wondering is, I guess what I'm wondering right now is, should I don't know if should I file for a petition for judicial review?
Did you have an attorney represent you?
What's that?
Did you have an attorney represent you at the mediation?
Yeah, I did. It was more like a pro bono attorney.
Okay. So,
and they really didn't advise me on whether I should continue, what I should do after that.
So you got to be careful. Sometimes you get what you pay for. The note, the deed of trust, the assignment, and the allonge related to those have to be properly accounted for in the mediation. If the bank that shows up or the representative that shows up on behalf of the lender bank can't bring those things, then what happens is the certificate that the bank needs to be able to record in order to foreclose on your property generally won't be issued. So my inkling is that you probably have the ability to stay in your house a little while longer because that certificate probably didn't issue. What you can do is call the Nevada Foreclosure Mediation Program and ask them if the certificate has issued. Or you can check the recorder's page, the Clark County recorder's page, assuming that you live in Clark County, and see if that certificate has been recorded against your property. But it sounds like you won, so I don't know what you would want to appeal for. But if you have further questions about that, shoot me the information at blacklabellolaw.com, and I'll respond to you.
We will jump right back into your calls. Lisa, thanks for holding on through the break. Good morning.
Hi, good morning, Tisha and Mark.
Good morning.
My question is, what kind of a nightmare will somebody have to go through, and what kind of a credit score will they need after they file a bankruptcy due to loss of income, divorce, and they were like primary on everything and had no choice but to do it that way.
Did you do a Chapter 7 bankruptcy where you wiped the slate clean, or is it a Chapter 13 where you're making the payments? A Chapter 7, you have 2 years after a bankruptcy to be able to obtain a FHA loan or a VA loan.
After a Chapter 7.
After a Chapter 7. For a conventional loan, your Fannie Mae guidelines basically say 4 years. But, that's obviously going to be more challenging. So you're really looking at, like, to do an FHA loan with 3.5% down. It's just 24 months from the date that the bankruptcy was filed in the discharge of debtor.
And what kind of credit score would she need?
Even though you had an FHA loan prior to the bankruptcy?
Oh, caveat there. If you had an FHA loan prior to the bank, so the FHA loan was included in the bankruptcy?
Yes, everything that we
So you wrapped it all in there.
I was primary on everything. I had never been late on anything. Had over an 800 credit score, and due to default on his end, I had no choice to do that because they were coming after me.
Yeah, you're either going to be a renter for a while, or you can come up with 20% down and do like the loan program that we were talking about a little while ago, where we've got some portfolio lenders where you can do a loan at a smidge higher rate. And when I say a smidge higher rate, still under 6%, 30-year fixed mortgage. With 20% down, though, that's probably the only thing that's going to be available to you for a while. That's 1 year out of a bankruptcy. And then your Fannie Mae, doing a conventional loan, you're going to be 4 years from the bankruptcy.
4 years under Fannie Mae.
Uh-huh.
1 year under a conventional with 20% down?
1 year for a portfolio lender, not your typical conventional loan. That's going to be, there's very few lenders that can do those, by the way. But they're out there.
And again, it's like we said before, Lisa, it's just not going to be as easy to find loans as it was, by going to the corner, going to the corner bank. It's going to be a little bit tougher, but certainly it's out there. You just got to look. I think those portfolio lenders are going to be the answer for most people here.
They are. We've got another portfolio lender that's been in talks with me now for a week and a half that's coming out with a loan program that's going to be, it's just unbelievable. However, it looks good, sounds good, smells good on paper. We have to see what it really tastes like.
Right.
But they're coming out. They're going to be coming back around. Bankers have a short memory.
You just really have to find somebody who can help you determine, who can look outside the box and be a little bit more creative than going, you can't get financing because Wells won't give it to you. So, call Mark at Sierra Pacific Mortgage. He was number 1 originator in the state and number 30 in the nation. So clearly he thinks outside of the box.
What's that number?
Our number at our office is 451-1040.
1040?
Yep, 451-1040.
Thanks, Lisa. Have a good day.
I appreciate your help. Thank you so much.
Thanks, Lisa. Appreciate the call.
Tim.
Hey, Tim, good morning.
Good morning. How are you?
Hi, Tim. This is Tisha Black. How can I help you?
I have a question for you. I'm almost 5 years into a 30-year. My arm resets at 5 years, so I'm pretty excited that it's going to reset down. There seems to be conflicting statements about the reset in the loan docs. One statement says it will reset tied to the LIBOR, I believe the 6-month rate, which is pretty low. It's under 1%.
Uh-huh.
And then, again, a couple of paragraphs later, it says the rate will not, I believe it said rise more than 2.25% every 6 months. So if the rate's going down in March, will it go down to the 6-month LIBOR rate, or will it only go down 2.25% toward that rate? Does that make sense?
That you're going to have to look. Do you have a rider to the note? There should be an adjustable rate rider. That should be a separate form with your note. So you've got a note, and you've got an adjustable rate rider.
And what would that tell me?
It would tell you the specifics. The LIBOR, the London Interbank Offered Rate, that it's very closely mirrors the Fed funds rate. So your loan's going to be whatever that is plus a margin, and that margin's going to be in those documents. So, and it will tell you what it's going to. And obviously, you can call your current lender and just call them and ask them. Say, hey, here's the deal. If it were to reset today, what would be my current rate? And they'll be able to figure that right there on their computers and tell you what your rate and payment would be. It's going to be a good deal for you, sir.
Yeah, I'm excited that it's going to reset lower.
Yeah, Tim, it's going to reset a lot. What's your current rate right now on your 5-year ARM?
6.875.
You're going to be in the 2s, I'll bet.
Yeah.
But my question is, is that pretty standard that, your rate doesn't obviously jump 4 points right away? It just jumps 2.25 points?
Yeah. That's very standard.
So I won't jump into the 2s right away. I'll jump down to the 4s right away.
I think it says,
6 months later, I'll jump
I think you'll go down to 2 immediately. And in terms of increasing back up, I think that 2 point... The 2 points
is the ceiling.
Is the ceiling that it can increase.
It can't go up more than 2 up, but it can go down to the floor.
Yeah.
So, call your current lender. You've got a better situation than you could imagine.
Yeah, I'm pretty excited. Well, I appreciate the good news. Thank you so much.
Thanks for the call, Tim.
Congratulations. Craig.
Hey, how are you doing?
Good. How are you? How can I help you?
Well, you guys touched on it earlier. I have impeccable credit. I'm up at 800, and I paid off my second. It was a 20-year second, and I paid it off in 6 years, 7 months. And the first, I'm down to 130, but the neighborhood is at between 60 and 80. Mm-hmm. You said you can short sell the house, and it wouldn't ding your credit too badly?
You can short sell your house without going delinquent on your mortgage. We've seen it several times. Now, keep in mind,
several times out of how many? Here's what I don't want to give false hope. I'm not trying to be a negative Nelly, but
negative Nelly. I like that. Uh-huh. We have seen it. You have to be persistent, and I mean you have to be stubborn. And when you call your mortgage company, boy, I'm going to get in trouble for saying this, but now that I've already started saying it. When you call your mortgage company, if they say, sir, you are not delinquent on your mortgage, we're not willing to consider it. If it were me, I would say, what was your name? I'm sure my attorney is going to want to know that you just told me to stop making my payment.
Uh-huh. You should do that. Okay. I tell you guys to do that all the time. Take names, numbers, dates, times, places, and how many times they've told you to do that. Because I could use that later in litigation.
Yeah, a mortgage company can't tell you to quit making the payment. You signed an agreement that says that you're going to make the payments on the mortgage. You took out a loan. These were the payments. This was the repayment plan. And you signed saying that you were going to make the payments. However, what nobody thinks about, a very good friend of mine in a business meeting probably a year ago, a CFO at a company, said, yeah, but Mark, the agreement says that if you don't make your payments, for whatever reason, you agree to give the house back to the bank. And I never forget, I'm sitting there thinking, man, I'm a lender. I do a lot of loans. I never thought of it that way, but that's right. That's what the contract says.
It's a bargain for remedy. If you don't make the payment, then, the borrower can get, a shot to his credit score. Right. The house forecloses, but the lender gets the right to take the property back. And the lender has the right, if they should so elect, in this state, to file for deficiency, and they don't. I haven't really seen them doing that to date. That's their issue.
I've only heard of one.
I've seen them on local community banks, but not national banks.
Gotcha.
So, Stephen, I think what you need to do is continue to press through this short sale and see if you can get one where you're paying. And then, as Mark says, we've recapped a couple times for a short sale, foreclosure, or anything to get new loans. It can be done. 2 years for an FHA VA, 4 years for a conventional, and perhaps a lower amount of time, 1 year for maybe a portfolio loan.